All right. All right, you guys can unmute yourself at any time to ask me questions. Please feel free to interrupt. As I had said earlier, we are going to be doing an in-person economic update October 26th here in Newport Richey, Florida. Our guest speaker will be Rick Lear, who is the CEO of Lear Investments. So he'll be coming in to talk to us about kind of what's going on with after third quarter markets going into fourth quarter and kind of what we're expecting for next year. Even though it will be an in-person economic update, we will always have the technology available so that we can do allow all of our non-Florida clients to participate as well. So we'll be sending that invitation out to you guys so you guys can hear what Rick has to say and kind of see where we're going into 2024, especially with it being an election year. So I'm just going to go over some highlights because there's been a lot that's been going in the markets over the last couple months. And then there's some things that I think are pertinent for us to talk about for at least the next 30 days in the market. So I'm going to go ahead and get started. But once again, if you have questions, just hit your microphone in the lower left-hand corner. It should unmute you and feel free to ask the question. Or if you want to type your question into the chat room, you can do that as well. All right. So this is kind of where my thought process is right now on the markets, is that there's too much focus on the actual markets, which means what did the S&P 500 do today? What did it do yesterday? The NASDAQ. But even though there's a little too much focus on the markets versus over, where do we think the economy is going? Where's the, what's going on with recessions? There's a lot of talk about markets. And part of that is because we do have two significant changes coming to the actual markets themselves, which means the exchanges that make up our stock market. One of those is the Russell 1000 growth, which is the basic benchmark used for growth managers. It no longer classifies as being diversified. Due to the narrowness of the market. So they're going to be restructuring the Russell 1000 within the next week. The NASDAQ 100 is also going to be reconstituted. Now the NASDAQ 100, the 7 largest company in the NASDAQ 100 account for 55% of the index. And that is the reason they're having to restructure this index. Now the 7 largest companies, those are your Microsoft, Apple, Nvidia, Amazon, Tesla, Meta Platforms, or Facebook, and then Google, or also known on the stock market as Alphabet. So basically the weightings of these have really thrown the NASDAQ 100 off kilter. So they're going to have to restructure those. This is going to put the market into a little bit of a tailspin over the next couple of weeks as that kind of restructures. It's going to kind of change what the benchmarks look like, which is also going to affect some of the computer algorithms out there that are making decisions on buys and sells in portfolios. So for those of you that are in the Dunham portfolios with me, you should have received confirmations in the mail that we took a significantly conservative approach to these managed portfolios over the next 30 days. And part of that is there's no sense in us taking this dip in the market if we don't have to. And so we did make those changes across the board there. New market cycles generally begin when the market has bottomed out after a dramatic pullback. In the last 2 decades, we've experienced 3 major meltdowns. The market fell 57% during the global financial crisis, 34% at the onset of the pandemic, and 25% most recently due to record inflation and surging interest rates. So unfortunately, the biggest 3 have actually happened in the last 10 to 15 years here. So that's, that kind of makes it difficult to kind of figure out what you're wanting to do. But the thing I want to get across is that these markets that we're in right now, there is nothing like these markets in the past. I mean, there are just too many differing variables to even attempt to mirror past markets, and that's okay. Because it allows us to focus on financial planning, diversified portfolios, and products that allow us to look at your strategies. Because remember, your investment strategy should be based on 5 to 10 years, not 5 to 10 months. However, that doesn't mean that we are not going to take a conservative approach in the next 5 to 10 months if we think that's going to be the best bet for you, because I don't want a huge market decline during the next 5 to 10 months to affect your financial plan for the next 5 to 10 years. But the most important thing is we have to be able to think outside of the box. That's the reason I'm always trying to bring you guys the best products, the best platforms for us to invest your money with, because I don't do it the same way everybody else does, because the same way is not always working. And that's the reason we want to take a little bit of a different approach to how we do things here at Full Circle. Now, one of the big questions that I've gotten over the last 60 days is cash, cash, cash. Is cash attractive? Well, of course it is right now, because most of you know you can go to the bank and get a money market or a CD paying you 4.5%, almost 5%. But just remember, we date cash. We do not marry it, because the cash is not going to allow us to combat inflation. Meaning this next 6 to 12 months, am I okay with cash portfolios? Obviously, because we actually just went to a significant cash portfolio on our money manager platforms. And most of you know that I've talked to you about putting cash into the money market that we have that's currently paying 4.75%. Why take the risk of the volatility of the market when we can make that kind of return on cash? Just as long as you understand that it is a short-term play for this cash. Like I said, we're talking 6 to 12 months. And even at the end of that 6 to 12 months, do we dump all of that cash back into the market? No, we don't. We're going to be looking at a dollar cost averaging, which means we put a little bit in at a time. Now, remember, the Fed wants you to move to cash, as this is how they control the algorithms for monetary policy. That's the reason the banks all of a sudden are, offering these great interest rates for your savings and your CDs. Part of it is because of the monetary policy for the Fed, because the banks don't want the Fed to raise interest rates. They want to be done. They want to sit right where we're at for a little while. However, the banks are going to start to get in a little bit of a trouble. You guys, most of you guys know I have no love lost for banks. They're not one of my favorite investments. And this is the reason why, is banks right now are paying you about an average of 4.5% on your CDs and savings, but they're only making an average of 3.75% on mortgage interest rates and personal loans, which means this is a losing game for them. They're paying out more than what they have coming in. Now, I know that a lot of the newer mortgages over the last 18 months are, these mortgages are being written at 6, 7, 8. I actually saw a mortgage the other day at 9%. That's great, right? But the unfortunate thing is the big banks aren't writing mortgages at 9%. They're just not writing mortgages. So you're working with some of the smaller and mid-cap banks out there. But once again, these banks are still paying, on average, they're paying out more than what they have coming in. And this is going to have a significant impact on earnings for the banks. And remember, banks tend to lead the recessionary pressures on the markets. Right now, we've had 3 of the 10 largest banks announce quarterly earnings, and their quarterly earnings came in relatively good. Basically, they beat estimates, but if you really, dig into it, you guys know how I feel about estimates, because estimates are the opinions of people versus looking at the actual hardcore numbers. So the bank's numbers are looking pretty good for second quarter, but I just do not think that's going to flow into third quarter, which is why we're taking that conservative approach to the portfolios. Because I think when third quarter earnings come out in October, it's really going to kind of put some pressures on the market. And part of that, like I said, is, they're offering the higher interest rates because they don't want those cash depositors pulling out, because a lot of people pulled cash out of the market after what happened with SVB and First Republic, which we talked about at our last quarterly earning. These were 2 huge bank failures, but remember, like I told you guys a few months ago, bank failures happen all the time. They just don't always make it into the media. It's just those happen to be very large failures of banking institutions, and that's the reason we're looking at those making front news. Once again, the challenge for the banks is going to be the fact that they have more going out than what they have coming in, and that's going to have a drag on the results, which we'll see next quarter. One of the other things I want to kind of keep in front of you guys is, we don't want to chase fads when it comes to the markets, so we don't well, this is the hottest, greatest thing, or so-and-so is saying this about that. It really comes down to the due diligence and, looking at the actual assets. And I'm going to give you guys an example here. As soon as I find my share screen so I can share with you guys. All right, so this is an example of a chart for ARK. Now, ARK Innovations is an ETF that was created, and it was basically supposed to be the next greatest thing when it came to investing in the markets, because the lady that started this is, basically saying she's the smartest person out there and she's going to be choosing all these great companies. So if you had started, with her back in, the early 20s there, you can see here, you've made absolutely no money. Now, most of you probably would have stayed in when you're doing this, right? So over a 2-year period, you're making a significant amount of money, but then this is what she's done. So she's actually back to flat. And this is the reason we don't want to chase fads, because the most important thing for me when I'm looking at investments is, what is the long-term outlook of this investments? And, I would rather look at individual companies and creating a diversified portfolio from those companies versus trying to chase fads. This was a technology fad that did not pay out. And that's where some of the concerns that I get coming from trying to chase, whatever the talking heads are talking about, because unfortunately, none of us have all of the right answers at the same time. There are no crystal balls. That's the reason I like taking the approach of just having a diversified portfolio and looking at what's working in the markets and what's not. All right. Any questions so far? I know I'm talking a little fast. I'll try to slow it down a little bit. Any questions? Like I said, if you have a question, just unmute yourself. All right, nobody's unmuting themselves. So we're going to go into the next topic, which is the recession. Okay, so the recession is the most forecasted recession that has never occurred. Now, there's a lot of people are really changing their tunes on recession now. So a lot of the economic advisors out there that were originally saying that, we were doomed and we were going to go into one of the worst recessions we've ever had. Now they're saying there's no chance of a recession. And we have nothing to worry about. And I'm going to have to disagree at this point. I told you guys last year that I really thought the recessionary scares were unfounded, and I did not see us going into a recession within the next year. We're now a year later and we've not gone into a recession. However, do I think we're going to go into a recession over the next 12 to 18 months? My answer is yes. And the reason is inflation came in at 3%. Last month, which means we're at 3% more than what we were paying a year ago. Because remember, the inflation numbers are year over year. So we're looking at June of 23 versus June of 22, which is not too hard to show, the benefits there. Because if you guys remember, June of 22, we were at 9.1% for inflation, and we came in at 3%. The Fed is really pushing us for us to get back to that 2.25% inflationary pressure. My opinion is I don't think we can get back there without an economic meltdown. And so I'm really hoping the Fed is going to take a breath and not do anything with interest rates next week. But unfortunately, I don't think that's going to happen, because no one's picking up the phone and calling me and asking me what I think. But I really think they probably are going to raise interest rates another quarter point, or they're going to threaten to do so in August. And so really where I think we're at right now is if they really do go another quarter to 50 basis points, which is what Fed Powell is talking about right now, that's definitely going to tip us over the edge. Because remember what I told you guys at the beginning of the year is that the Fed gets us right to the edge of that cliff, right? And we don't really know what is or is not happening until we fall off the cliff. We are at the edge of the cliff right now. And I would really like to see the Fed take a breath, take a breather, and see what we can actually do with some of this, with the inflationary numbers that are coming in. Because remember, the inflationary numbers come in and then they get recalculated and then come in again and then they get recalculated. So you get recalculated 3 times, and then that's how we get our GDP. So GDP is actually coming in at 2%. Most people say that's actually pretty good, but that's not 2% for the quarter, that's 2% for the annual, which means basically the US economy grew by 2% over the last 12 months. Whereas before we were at 2% a quarter. Why are we only at 2% annually versus 2% a quarter? The reason is that globalization has gotten a lot tighter. Competition has been a lot more constrained. And that's the reason we still have the supply and demand issue that's still kind of driving our inflation, because the less competition, there's less price measures, right? So with globalization, we've kind of hit that peak, which basically means as a global economy, we kind of got to take a step back and figure out who's the best at the best. And you're going to see a whole lot more mergers and acquisitions happening versus more new companies popping up, because it's just the competition has got a little bit tighter. Also, one of the things we have to keep in mind next year is we are going into an election year, and is this good for the market or not? Historically speaking, election years usually are good for the market. However, this one is going to be as volatile, if not more volatile, than what the last election was, depending on who is going to be the Republican candidate versus the Democrat candidate. I'm not going to get into politics, because politics are not what's important to me. Investing your guys' money and making you money is what's important to me. However, I can't discount the historical factors of a Democratic president versus a Republican president versus a reelected president versus a non-reelected president. So a lot of variables go in there. And unfortunately, we have to kind of throw out the last 8 years, because we had a pandemic that happened in there. And so, even the historical numbers that we look at with the changing of the guard, so to speak, in the White House, kind of has to get thrown to the wayside, and we gotta kind of figure out what the new normal is going to look like. However, really my focus on is not who the candidate is, but what are the platforms that the candidates are getting on the ticket for. So are we going to be talking about taxes? Are we still going to be talking about student debt? Are we still going to be talking about whether it comes down to, social issues like abortion and activist rights, or is it going to be more on economic issues like taxes and the student loan crisis and our debt ceiling? So depending on what is going to be the platform issues is going to give us a better idea of what the markets are going to do next year, because you'll see the fluctuations happening based on that. So we don't know if the election year is going to be good or bad. The great thing is the platforms that we're bringing to you guys now give me that flexibility to move you in and out of where we think you should be, so that we can take advantage of that. Inflation is still remaining high. I actually have a chart for you guys on the inflation numbers. Obviously they're coming down. It doesn't feel like they're coming down, but they are actually coming down. So you can see here, January we had food at 10%, and now they're saying that food is coming in at 5.7%. And then splitting that up is you got food at home is 4.7, which means the grocery store should be a little bit cheaper than what it was at the beginning of the year. I don't really think it's that much cheaper than what it was at the beginning of the year, but I think people are spending money on different things. So remember what I told you guys before, that consumer spending has to get under control, which means we have to be able to start making those hard choices of what we're spending our money on. And this is where that number is coming into play. So instead of still buying the filet mignon because we got the money to do it, people are tightening their belts a little bit. And I think that is what's kind of pushing some of the prices down at the grocery store, or the prices are not rising anymore, because what we're paying at the grocery store hasn't come down, right? I know most of you are nodding your head at me right now, even though I can't see you. But the price increases have come down. That's what this number is. Not that we're paying, 7% less at the grocery store. It means prices have not gone up any further. I'm hoping that makes sense to you guys. You can see eating out, this inflationary number is really not coming down. Part of that is service industry. Here in the state of Florida, minimum wage went up a year ago. It's going to be going up again in September of this year. This is going to continue to put pressure here, because they're going to have to pass those costs off to you. So in order to pay their employees more, they're going to charge you more for the food. And that's the reason these numbers aren't really changing a whole lot. Energy, obviously, back in January, gas prices were a whole lot higher than what they are right now. So you can see that's where kind of that difference is there. You got gasoline, you got electricity. Once again, this is a cyclical area when it comes to CPI, because obviously electricity is more expensive in the winter than what it is in the summer in the Northwest, whereas down here in Florida, electricity gets a little bit more expensive in the summer than what it does in the winter. So once again, this number is very cyclical. Apparel, you can see here, if you have to go to the store to buy clothes, it is what it is. You got new vehicles. New vehicle prices are coming down a little bit. And Part of that is just because people aren't buying them. It doesn't really have to do with the fact that the inflationary pressures are not there for new vehicles. People have just stopped buying new cars because they don't want to pay the prices. This is the biggest concern right here for me is medical care commodities. You can see here we're still we're going up, we're not going down. So that's definitely a concern. Shelter, you can see housing prices are pretty much holding steady. They're not going up, but they're also unfortunately not coming down. And then you have education and communication prices. So you can see here, they're pretty much once again holding steady, not going up, not going down. And that's why it really feels like we're still paying a lot for everything. And that's not really going to change. You're not really going to see a whole lot of price cuts coming in, which means we really have to focus in on re-looking at those budgets and re-looking at the financial plan and making sure that what we're planning for now versus what we planned for 2-3 years ago when you guys started doing financial plans with me, if we're still on the same page. So you guys will see as we start doing our annual reviews over these next 6 to 9 months, you're going to see me asking a little more budget wise questions, because we need to make sure that the now remember your financial plans already had inflation built into it. So you know, when we looked at the plans 3 years ago, 50,000 3 years ago is obviously not 50,000 today, and we plan for that. But I do think we need to go back and look at it again and just make sure that we're all on the same page with the numbers that we have in the plan. And I'm hoping you guys understand that. Any questions? Remember, just hit your microphone and it will unmute you and you can ask any questions that you have.
Hi, Dottie.
Hi,
Historically, what did different presidents mean for the stock market?
Republican presidents usually always, after a Republican president goes in, the market's usually up 10 to 12%. A Democratic president, the markets are up 7 to 8%. I mean, so really at the end of the day, you know, the markets go up after that new president goes in, but usually what we like to look at is the 18 months after that new president is in. And unfortunately, it is literally 50-50 because it comes down to the president, not the party, as far as what markets do. Because obviously Republicans like low taxes. Democrats like higher taxes. And so that's the reason we usually have to wait till about 18 months after the president is in to know what kind of economy we're going to have or what it's going to do to the markets. Does that make sense?
Yep.
All right, perfect. Any other questions? Okay, well, those were the big things that I wanted to talk to you guys about tonight. Like I said, we try to keep these at 30 minutes or less because I want to be respectful of your guys' time with your family, but just want to make sure you guys kind of know what we're thinking, where we're at here at Full Circle Financial. Like I said, we will be having Rick Lear from Lear Investments doing our market update in October. So those of you that live in Florida, join us in person. But those of you that do not live in Florida, you'll have this same format. So you'll be able to see and hear and know exactly what's going on. But that's pretty much all I had for you guys is cash. I know it's attractive and I'm okay with us taking a conservative approach and putting more in cash, because if you can make 5% in cash, why take the volatility of the market? Just as long as we understand that, you know, 5% is not going to be long-term, because those money market rates are variable. They are not fixed, which means you could have 5% today and 3 months from now, you could be back down to 3%. So just as long as you guys are keeping that in mind, that cash, once again, we date it, we don't marry it. And then, like I said, the recessions, I think for the next 6 months, we're pretty much recessionary proof. However, I think going into like month 9 and 10, you guys are going to see where I'm really kind of pushing towards a conservative approach going in to see how we're going to deal with the recessionary pressures, because they're not going to be an overall economic recession. I still stand behind that, what I've told you guys for the last 9 months. I do not see us having a full economic recession, but I do see us having some cyclical recessions where there's going to be certain parts of the economy that are going to be affected more than other parts of the economy. But we do still have to be careful of the trickle down effect of each of those sectors. So right now, stay the course. I don't think we need to make any huge changes to anything other than what I've already done on the managed platform side. you know, and, you know, we should be good from there. So if you guys don't have any questions for me, which I'm really shocked you don't have any questions, you guys are each free to go and enjoy your evening. It is hot here in Florida, so I'm hoping that where all of you guys are at is not as hot as it is here. All right, if there's no questions, I'm going to say good night and everyone have a lovely evening.
Right.